If you own a home, you may be sitting on a financial tool that's more powerful than you realize, but is it working for you? In this video, I'm going to break down what are HELOCs, when is a good time to refinance, and how can you make the equity in your property work for you, and how I can help you. So stay tuned. We're going to go over everything you need to know if you currently own a property and how you can tap into that financial future through the equity in your property. Welcome back. My name is David Moyer. I am a local real estate expert here in Dayton, Ohio. And today we're diving into equity, something that most people don't think about once they move into their property, unless it's time for them to sell. And in this video, we're going to talk about how you keep track of your home's equity. There are various ways that your home's equity goes up. The first and foremost and easiest way is simply making your payments on time. When you close on a property, you will get what's called an amortization chart. This is going to show you how much of your payment goes towards the principal of that loan, how much goes towards the interest, and how much goes towards those property taxes and the insurance. And it's going to show you the value of that loan and how it changes. Fun fact, the longer you make the payments on time over the course of the 15, 20, or 30-year life of that loan, the faster that principal goes down. So on year 1 through 5, the principal may be actually really small and not paying down the loan very quickly, but on year 20, that principal amount is exponentially larger. So that's one way. Also, fun little tip here, if you make one extra payment per year, and that can be one bulk payment towards your principal per year, or it can be breaking down that principal payment by 1/12, adding it on to your monthly payment and making those payments so that at the end of the year, one extra payment has been made. That can cut the life of your loan down by 7, 8, sometimes even 9 years. So you can exponentially expedite the process in which your equity builds and how quickly you're paying down that loan. Now, likewise, once you move into a home, it's a little bit different than buying a car. When you buy a car, the depreciation starts almost immediately when you drive off the lot, right? We hear this all the time. But when you move into a home, there is appreciation. The home gains value. It is a limited supply in our market. So you see the value of that home continue to increase. So not only are you paying down that mortgage and you're building equity that way, but on the back end, your home value is continuing to go up. So that is something that you want to keep track of once you move into a property to see how much equity you have built. We've all heard the terms sweat equity as well, right? Sweat equity means you buy a property that maybe needs some cosmetic repairs or maybe some pretty substantial repairs such as a roof or a furnace or a water heater. When you make those changes, when you make those upgrades, when you keep your home current and keep those updates current, you're also helping the value of the property continue to go up. So if you're looking at, let's say, remodeling a kitchen, and let's say your budget for that kitchen is $25,000, you are going to increase the value of your property once you complete that project by maybe $15,000 to even $20,000. The return is not 100%, nothing in life is 100%, but by making those changes, you're increasing the value of the loan. And also, last little tip, if you had put down less than 20% when you bought the property, you probably have something called PMI. That's insurance on your loan protecting the lender in the event you default. And until you pay that down below the 20% of what the value of the property is, you're going to have those monthly payments and they can be pretty substantial. So if you make improvements to your property, keep track of what the value of the property is, and also pay down that loan faster, once you meet that 20% down threshold, you can actually do a refinance of the property, get that PMI off of there, and then make greater strides in paying down that mortgage and having that equity when you're ready for it. Now, a smart move for a lot of homeowners is when they start to consider, when's a good time to refinance? As a real estate agent, I get this question a lot. People will call me after they've closed on their property. Maybe it's been a few years and the rates have changed. So they want to know, David, should I really refinance or what are my options? So let's say you close on a property today and the interest rate is 7%. and you're in the home for a couple of years and all of a sudden the interest rate is 6.5%, or maybe even 6.25%. You may think, well, if I do this, I can change my payment by a little bit, maybe even a couple $100s, and that's going to save me money in the long run. Keep in mind, when you refinance that property, there are things to take into consideration such as closing costs and how long it would take for you to recoup that. So let's say in this circumstance you close on that property at 7%, and in a couple years the interest rates change to 6.5%. You give me a call, we talk to your lender, and they say, well, sure, your payment right now of, let's say as an example, $2,000 a month could change to $1,900 a month or $1,850 a month. So you're going to save $100 to $200 a month. But the closing costs on that refinance could be $2,500, $3,000. So you want to take into consideration, okay, if I'm saving $100 a month, but I'm paying $300 to refinance that loan, I need to be in the property for at least 30 months after that refinance so that I then start to see the benefits of that refinance. This makes perfect sense if this is your forever home, if you're doing this on year 2 or 3 and you plan to be in the home for at least 10 years. But if you're thinking, I'm going to refinance, but we may be selling here in just a couple of years, sometimes looking at the math is going to save you a lot of money in the long run. Just because you get that lower payment potentially because of an interest rate change doesn't mean you should always refinance. I've talked about this a lot in the past in some of my other videos, but a really powerful tool that a lot of homeowners choose to tap into is called a HELOC loan. HELOC essentially stands for Home Equity Line of Credit. And that means you are borrowing against the home for things such as upgrades to the property. Maybe you really want to remodel that bathroom or that kitchen, or maybe you need to put a roof on the property but you just don't have the cash and you don't want to finance it through that contractor, so you look at a home equity line of credit. Typically they can have some lower interest rates than what you can get on the open market because there is the stability of leaning against the property that you live in. So you can take that cash out and you can use it for those improvements, thus increasing the value of your home. That's a really smart way to use your money if you're looking for an easy way to make those changes. Or maybe you're simply looking to pay down debt. A lot of people that have good equity in their property will use a HELOC loan to pay off or pay down those credit cards, pay off that auto loan that's maybe hindering them at the end of the day, and consolidate that all into a single loan on their property. Now keep in mind, let's say as an example you have a $300,000 property and you have $50,000 worth of equity. So you only owe $250,000 on that loan and your home is worth $300,000. It does not mean you can take out $50,000. Remember that bank still wants to see a little bit of equity at the end of the day for that primary mortgage. So get with your lender. They're going to tell you exactly how much of that you can take out and use for the improvements and for the debt consolidation you're looking to do. I've also seen people that when the market is good and there are investment strategies they want to make that have a greater return than what the interest rate is on that HELOC, they will take the money out on the HELOC, invest that into the market, and then pay the HELOC on a monthly basis. It's a smart money move. I always am happy to go over these situations, and I have a great lender I can put you in contact with as well that's going to look at all these scenarios. Everybody's different. Like I said, it depends on how long you're going to be in the property, what your plans are, and what your financial strategies and future goals are, so we can help you. Not only do I sell real estate as getting you into your dream home and helping you achieve the American dream, but I help you achieve wealth through real estate. Now, of course, all this refinance talk and HELOC talk and keeping track of what your debt ratio is, what your loan to value ratio is, these all mean nothing unless you keep track of what the market is doing. The market fluctuates on a very regular basis, sometimes week to week, sometimes month to month, depending on the temperature of the economy. So it's always a good idea to keep track of what are my neighbors doing? What's the neighborhood doing? What is the entire region that I live in doing? How is the real estate market? Even if you're not thinking about selling, this is an important number because it can help you make your plans for the future. One thing I do for my clients is when they move into a property, or even if I meet them and their goals to move are not for several years, but they currently own a home, is I set them up on a monthly market analysis. What I do is I go in and I take a look at what the neighborhood is doing, what those comparable homes are doing where they live, so they can keep track of all that information. Then they can explore deeper into those homes, take a look at the photos, see what the competition is looking like, or give me a call and say, hey, these numbers look really good. We're thinking about doing a HELOC. We're thinking about refinancing. And according to that monthly update you sent us, it looks like our home has increased in value quite a bit. Could you give us a more stable number so we can really make that decision? And the answer is always, of course. That's what I'm here for. I'm not just here to get you into the home. I'm here to help you every step of the way, no matter how long you're in that home or how long ago we closed on that property. So when you look at it and you say, David, it looks like my home has gone up by about $25,000 since we closed on the property. What do you think? I can do a more deeper dive into that and do what's called a comparative market analysis. That's comparing you to similar properties that have similar features and how your home would rank if you were to sell in today's market or if you're just looking for the value. Keep in mind, it's always good to know, hey David, if I needed to sell, what would my value look like? And that's because you never know when that circumstance is going to happen. Life changes. I see clients all the time that buy their forever homes and then in 5 years something happens, their life goes in a different direction and they need to make that move. So staying on top of those numbers is important, and that's what I'm here for every step of the way. So there are 1,000 creative ways to really use the equity in your home to work in your benefit. Maybe you're looking to start a home-based business, and this is how you're going to start your seed money for that business. And like I said before, maybe you're looking to do an upgrade or a remodel in your home to boost the equity and boost the value, and you need that money out of the equity to make that happen. Once again, your seed money. There are 1,000 different ways. Or maybe your life has changed. Maybe you need to stay in the home, but you need some better accessibility features. Maybe you need to widen the door. Maybe you need to install a ramp in the front of the house. Maybe somebody is moving in with you that needs that first floor full bath, and all you have right now is that half bath, and you're looking to make those changes. We can go over all the different options and how you can make that happen, and once again, how you can achieve wealth through real estate. So just to recap, home equity is a really powerful tool if you use it wisely. Just tapping into your home equity because you're looking for extra cash flow, you're looking to pay down something that maybe is frivolous, is not always the best decision, and everybody's circumstances are right. I don't need to know exactly what you're using that home equity for, but I can tell you the ramifications of doing it too soon, too late, or based off what the market conditions are. That's what I'm here for. So if you're looking to make a smart move with your financial strategy, with your equity, with that home equity line of credit, or you're just saying, David, remember that pink bathroom in the house? I'm finally ready to make that change. Do you think I should do that? I'm going to be in the home for 5 more years anyway. This is what I think it's going to cost me to do that. Can we look at an analysis of my property and see if I have good equity in the home to make that happen? The answer is always 100% yes. Let's do it over the phone. Let's do a Zoom call. You want me to swing by and take a look at your plans and talk to you a little bit about other bathroom remodels I've seen on the open market? And if this is a good move for you as well? Absolutely. That's what I'm here for. When I'm your realtor for life, and I really truly mean that. After 20 years, I have helped so many people in every single stage of their life, and I'm here to do that for you as well. So like I always say, make sure you like, subscribe, comment. Let me know some of the questions that you have about how you can make your equity work. Let me know some of the stories. If you're watching this video for the first time, and even if we've never met, if there's something that you did that really made a difference in your home's value that you would like to share with others, comment below. I want to know all about it. I want to hear all the different stories out there. What benefits you can benefit somebody else. So why not share the wealth while you're building your own wealth? Thanks for watching.